Hi, I'm Phil Mackintosh, the Chief Economist at Nasdaq, and today we're going to be talking about things that are going to affect the 2024 economic outlook. Now we're going to talk about the interest rate outlook for 2024, and if we think about where we are in the cycle, we've had a really quick period of increased interest rates. That was to tamp down inflation, and typically when we get to the top of an interest rate hiking cycle, you often end up with the government overslowing the economy and a recession, which you see in the grey lines in this chart. The question is, can we do a soft landing this year, and where will rates end up? And there's two things driving rates down. One is obviously inflation, which has been falling really quickly, not just in the US, but around the world as energy prices fall and food prices fall and wages start to slow. But also there's a demographic factor. And if you look at this chart, what you see is that the underlying rates of inflation back in the 70s were much stronger, but so too was the rate of GDP growth and the growth in the labor force. And so what you think of back in the 70s was a really strong economy, lots of young people needing to buy houses, needing to buy white goods, just a generally hotter economy. What you see as you go through the next few decades is that each time the economy heated up, the level of interest rates that was needed to cause one of those recessions, to cause the economy to slow down, was lower every time. And so what you see is interest rates kind of track the same pattern as the workforce, as the population. As it slows, the amount of interest rates we need to slow the economy down also falls. So what's the outlook for this year? Even the Fed has said we're probably going to be starting to see interest rate cuts. The question is how many? So there's an expectation that growth is actually going to be pretty slow this year. Inflation, if it gets down below 3%, close to 2%, you can see what the market's forecasting for rates here. A pretty dramatic fall, but not actually that much of a fall compared to where inflation's going to be. That leaves real interest rates, the difference between the interest rate you earn and the inflation that takes away from some of those returns, actually still pretty positive. So I wouldn't be surprised if we see the economy slow down, we might see rates fall even further than the market's pricing in. So let's talk about the employment outlook for 2024. If we think back to what happened with COVID, obviously a lot of people in the US lost their jobs when businesses were shut down. But since then, we've had a really dramatic recovery. And even in Europe, you can see the unemployment rate is at multi-decade lows. So the employment situation right now is really quite strong. We've been through a couple of cycles though. You can see one of the things that happened when we had COVID is a lot of people looked like they did early retirement and they haven't come back into the workforce. So the supply of workers is still a little bit lower than normal. But the good news is those prime age people have come back into the workforce. And actually the entry of new people into the workforce is one of the reasons why the employment rate is starting to tick up. What's interesting is when we recovered from COVID, there was so much demand for new workers, especially in the sectors like leisure and hospitality and in health spaces, even in construction, that there was a huge demand for workers, not enough workers coming back into the workforce, and so wages actually increased really quickly. The good news is for companies, those wage increases are starting to slow. I guess the bad news is for consumers, the economy is also starting to slow. And so some of the wage gains that we've seen in the last 2 years probably won't continue. Especially in the manufacturing sector, we've seen pretty slow growth to some contraction, and even services have come way off their COVID high. So if we look at the unemployment situation for this year, we can see that those jobs that were open have started to shrink dramatically. Even new hires has slowed right down. And the workforce isn't quitting at the rate that it was because there's just not as many high-paying new jobs to jump to. So the basic story of unemployment and the labor sector in 2024 is it's going to be a little bit more like the old normal. So now we're going to talk about consumer spending, and consumer spending's been really important because if you remember back a year ago, everyone was talking about the possibility of recession. And if we look at these 6 metrics, you can see that basically all of the 6 metrics are pretty strong, definitely not weak. So we're not in a recession this year. And one of the things that's really driven that is the consumption from the consumer, which has been powered by strong employment and wage growth. At some point, the theory is that that consumption has to start to slow down. And one of the reasons is because people are going to run out of all those COVID savings that they had. If we look at some of the underlying data, it does seem to show that at least low-income workers have spent most of their COVID savings, and it looks like they're starting to put some money on credit cards. Credit card debt actually hit a new all-time high notionally, but when you factor in increased wages, it's not as bad as it looks. but people are still starting to use credit cards. And that's a sign that the consumer is going to have to start focusing on their budget a little bit more, which means maybe 2024 is going to be a little bit harder for the consumer to keep the economy chugging along at the super strong rate that it did in 2023. We can start to see some of the credit card delinquencies increasing as well. If you look at automotive and credit card outstandings, they've started to increase. And so there are definitely signs in the economy that the consumer in 2024 might not be as strong as it was in 2023. So now we're going to talk about housing and the outlook for 2024. And the housing sector is one sector that really there's still a bit of a COVID bubble in. If we look at what's happened in the housing sector, obviously with interest rates increasing, mortgage rates have increased tremendously, more than tripling in the last couple of years. And yet, even though mortgages are higher, the prices of houses haven't fallen. And so if you do the math, we had a huge rally in house prices during COVID, then we had an increase in mortgage interest rates after COVID. The cost of buying a house, the affordability of houses, is at multi-decade lows, even worse than we saw before the housing crisis in 2007 and 8, all the way back to the 80s when, remember, Volcker had to put interest rates up into the teens just to tackle inflation back then. So what's happening with housing and why are things still so stretched? Well, one of the interesting things is it looks like a lot of people took out long-term fixed loans. And the way we see that is on this chart. The mortgage rates in red, you can see, have increased tremendously. They've tripled. They even hit about 8% recently before falling back a little bit. And yet the average mortgage rate being paid by households has hardly ticked up, which shows that a lot of households have long-term pretty low, below 4%, about 3.6% fixed rates. The problem is that means households with a 3.6% rate don't want to sell their house because then they'll have to reset to those higher 7 and 8% rates. And so what's happened is there's been a lot less houses on the market. There's been no supply of houses for people that really need to buy a new house to buy. And ironically, what that's done in a high interest rate environment is supercharged new construction. And so you can see the only houses that are out there for people to buy are new construction. That's actually created a distortion because construction spending usually in a high interest rate environment would be weak, and actually it's been really strong. So now we're going to talk about companies and the stock market and the outlook for 2024. And if you look at some of the surveys, especially for small businesses, there's a lot of negativity out there. Forward orders are relatively weak. Definitely the activity levels have come down off those post-COVID recovery highs. And yet, if you look at the earnings picture, a lot of companies are starting to show an earnings recovery. We had a huge spike in earnings and strong margin as we came out of the COVID recovery. That was impacted a little bit by increasing wages as inflation started to feed through to workers. But now what we're starting to see, especially for the large cap companies, is earnings are back to all-time highs. And even for some of the small cap companies, earnings have turned the corner. And so earnings are again starting to grow, which should be a tailwind and a good thing for stock valuations. If we look at the recovery in earnings, it's actually pretty broad-based. If we look across all 11 sectors, there's only 3 sectors with earnings contracting year on year at the end of Q3, and that's expected to change in next year as well. All 11 sectors are expected to see earnings growth, although the consumer-driven growth that we saw in 2023 that really affected the communications and the consumer sectors is expected to slow a little bit because the consumer is expected to have a little bit less spare cash and slow down their spending as well. So what's that mean for the stock market? Well, it's pretty interesting looking at what's happened in the stock market. They say the stock market predicts, in this instance, 9 of the last 6 recessions. And so if we look at the market returns when there was a recession, we see that red line and the red average area. What we've been doing now, the black line, is tracking the blue lines though, and that's when the stock market has a bear market that turned out to be a soft landing or not a recession. There was a little hiccup, if you remember, back a month ago when the 10-year interest rates in the US started climbing, even though the Fed had basically paused interest rates. But with the new outlook for interest rates to start falling and the 10-year rate now falling back below 4%, we've seen that black line, which is the current market, return all the way back to a soft landing scenario, back to almost all-time highs. What the market's saying is we look like we're going to have a soft landing. That means earnings recover, interest rates fall. They're both tailwinds for stocks. The question is, has the market already priced in some of those tailwinds, and how much stronger can the market be in 2024? So now we're going to talk about the inflation outlook and what it means for interest rates in 2024. And if we look at inflation, we all know in the recovery from COVID, inflation got up to really high levels, levels we hadn't seen for decades. And looking at this chart, you can see the breakdown. Energy prices as oil went up during the Ukraine war. Food prices were inflated by that and just increasing wage costs as well. Car prices went up because there was a shortage of chips. Pretty much everything was going up in that period in the 2022 era. But what we've seen in 2023 is a lot of inflation coming out of the system. Secondhand cars are now deflationary. Their prices are falling. Same with energy prices. And even some of the new cars and other goods are now starting to see prices that are flat year on year to falling. If we look at what's really holding inflation up in this chart, you can see it's the purple and the blue. So let's look at the purple and the blue because they show that inflation should keep falling in 2024. And the reason we say that is if we look at the purple here, what we're seeing in the purple is the cost of housing. It's effectively the cost of rentals. And rentals, as we mostly know, you sign up for a 12-month lease. So a lot of the old rental increases are still stuck in a 12-month number. If we look at something like Zillow or this indicator here of new leases being signed at the current time, in the current month, you can see the inflation rate on new leases has fallen all the way back down to around 2%. So the forward indicators show that as all of those old rent increases start to roll off, the new rent increases are going to be much smaller, and that's going to feed through into the CPI rate. The other thing that's definitely been helping inflation come down, and looks like it's going to help in the future too, is wage growth. So in the US, we saw with a huge shortage of labor in the 2021-22 recovery, demand for labor picking up as people came back spending on services, big spikes in wages, a lot of people quitting for higher paying jobs, and all of that has started to normalize, and so too has the wages growth. And so with wages growth right down to 4%, you can definitely see the feed-through effect should also help inflation start to slow. What's that mean for interest rates? Well, if we look at the outlook, growth is meant to be relatively slow, and if inflation gets down to around about 2%, and it's only just over 3% now, the real interest rate, if we look at what the market's pricing in, even if it comes down 2%, still is very real positive. The real rate is the difference between the interest rate you receive and how much inflation takes away from those returns. We haven't had positive interest rates for years, and there's a few demographic reasons why we really shouldn't have positive interest rates of 1.5% to 2%, which is what the current forecasts are showing. So it's likely that interest rates are going to fall, and remember, if inflation starts falling faster, even if interest rates stay at the same level, the real interest rate increases, which is actually contractionary. So if the Fed wants to start to speed the economy up or stop it from slowing down, interest rates are going to have to fall, which is what everybody's talking about and what the market's pricing into. So thank you for following along, and stay tuned for updates from me in my weekly Market Makers newsletter.